everyone, most weighted news is out now. Fed has cut the rate by 50 basis points. How will this impact the US and Indian market? Will the US market surge and outperform India now onwards? We are going to discuss everything in this video. Stay tuned till the end. If you are new to this channel, I'm Keerthi. I run the consultancy, a firm which is specialized in NRI services. I have completed my CS from India and CMA strategic level from UK. I'm also a SEBI-registered overseas MFT. Every week, I bring an explainer video here on various issues related to NRIs. If you are looking for FEMA, finance, investment-related topics, please consider subscribing to this channel. Today, we are going to discuss in detail the impact of Fed rate on both US as well as Indian markets in this video. As an NRI, you may be having exposure to both of this market. In this video, I will discuss what strategies you can adopt in the days to come while managing your finance or investment in the both market. Before that, it is important to know how and why Fed has cut the rate and what is its impact. We all know how USA is a big brother and it influences the stock as well as the debt market all over the world. When Fed or Federal Reserve aggressively hiked the interest rate to tame the inflation post-COVID, USD has become stronger. Short-term bonds gained momentum because they paid better return than the long-term bonds. So there was a flight of capital from the emerging markets to US. Now that Fed has brought down the rate by 50 basis points, which is quite aggressive for its present macro, it will make USD weaker. There will be more demand for the long-term bonds. Due to the improved liquidity, there will be high inflow towards US equity and the stock market will definitely surge, but in short term. If you compare to the Indian markets, the US market had underperformed in last 3 years. In the last 3 years, from January 2021 till September 2024, S&P 500 had given 57.7% returns. Nasdaq 100 had delivered 48.28% results, whereas Indian Nifty 50 has given 76.88%. It was a massive underperformance for US. Even after comparing the rupee depreciation during this time, which is around 14%, Indian market have outperformed US market by more than 10 to 12%. Stock market underperformance is only one factor, but overall, there was actually a pressure on Federal Reserve to cut the rate in US. If you are following the US economy, you know that now unemployment rate is really high. Inflation is again going higher. Recently, the report has supported this. But still, the rate cut was done because Fed had to script this soft landing. When macro in any economy is good, interest rate cuts are actually going to boost economy. But with this kind of debt level, unemployment as well as inflation rate, is it a good move or was it done to avoid recession, immediate recession, and there was no other option? Is it really possible to shift the focus from inflation controlling policies towards growth in US? These are the questions every economist is discussing today. Generally, any economy should not be expanding just by monetary policy. Any common man can understand, right? That's what exactly US is trying to do now. Print money for post-COVID recovery, restrict when the inflation rises, again reduce the interest rate when you are staring at recession. It looks like to drive the much needed inventory out of existing sales or to fuel the consumption and not considering the macro. So Fed was probably less concerned about the long-term inflation and more concerned about its pictured, promised soft landing. Can US continue to stimulate real growth by making credit cheaper? It will bring down the borrowing cost, I agree. But I personally feel this move is disastrous in long term. Whereas if you compare in India, exactly opposite is happening. SEBI is successfully implementing lot of measures, restricting the speculation, and even the government is encouraging the long-term investing. RBI has strict control and managed to keep the inflation at less than 5% for an import-dominating country like India. Look, the inflation is actually under control. I really don't think that RBI is going to follow the suit of Fed and make the interest rate cheaper. Rather, it might continue to monitor the inflation inflation, keep the liquidity tight in an economy, observe the deposit rate on the bank, because see, now banks are losing deposits. If the rate cut happens, then it may be building unnecessary pressure on the banking sector. So, in India, they are aware of one fact: real growth matters. Nominal growth in an economy is nothing but a combination of inflation plus real growth. They are trying to maintain a healthy balance here, because it should not be an inflation which throws the country in whirlwind. But consumption plus capital expenditure plus private investment should be boosting country's economy. Clearly, the results started appearing now in India, and the structural changes initiated by the government, strategy of the government, all the digital physical infrastructure, and the wonderful efforts placed by RBI and SEBI, they started paying off now. These efforts had shown in Indian markets outperformance in last 3 years. As you are aware, from 2021 to 2024, the Indian equity markets have consistently outperformed their US counterparts. If you go beyond this question, why Indian markets are doing or should be doing better than US? Answer to this question is never easy. In addition to the regulatory changes of RBI as well as SEBI, this outperformance is the result of several interrelated factors. As an NRI, if you want to understand why Indian market had outperformed US market and how both markets are placed, you need to analyze multiple factors. So let's begin. First thing first, do you know how stock market works? If you know this, the economic growth stands as a fundamental driver of any country's stock market performance. And currently, India's growth is much better than US. It is consistently exceeding 6% annually. In contrast, the US economy had grown at a modest pace, typically 1 to 2% per year. The substantial difference in the growth rate has created more dynamic environment for Indian business. The rapid expansion of Indian economy has led to increased consumer spending, infrastructure development, and business investment. These factors have collectively fueled the corporate growth and profitability, making Indian stocks increasingly attractive to both domestic and international investors. When the country's GDP increases, that generally is reflected in the corporate earning of the companies if the macros are strong. Corporate earnings, which are a critical factor in any stock valuation, have shown impressive results in India. Indian companies have demonstrated robust profit growth, with the earning often increasing by 10 to 35% on year-on-year basis. And most importantly, the earning growth is not coming from only, few sectors. In India, it includes almost all sectors: information technology, pharmaceuticals, consumer goods, financial services, and whatnot. US markets, whether it is S&P or Nasdaq, the company's earnings actually is largely dependent on tech sector. So it's almost like a thematic investment. These companies are still in huge profit, I agree, but there is a risk of concentration. Companies like Nvidia have shown great results, but the same is not true for other big companies like Google or Apple. They have shown variable results. After a strong rebound in 2021 following COVID-19 downturn, US corporate earnings have been less consistent, affected by many factors such as supply chain disruption, labor shortages, inflationary pressures. The steady and substantial growth in Indian corporate profit has been a key driver of country's stock market performance, attracting investors seeking better return. As an NRI, if you haven't invested in Indian stock market, this is the time to start. If you want to invest through us, reach out to us using our website www.keerthisfinfo.com or the link which is given in the description. Once you fill the form, our team will get in touch with you. Despite geopolitical tensions around the world, Indian market is stable because in India, the main reason for this is stable corporate earning. Nifty is hitting all-time high. For a common man, it may look really expensive, but in index level, the PE or price to earning ratio is just 23.6, just 1% more than the median PE of 22.6. So there is so much scope to grow. This clearly shows that the companies are able to record increase in the earning growth because India has managed inflation really well in the past 3 years, despite global inflationary pressures. Reserve Bank of India and the Indian government have done commendable job. They have managed to keep the inflation largely largely within this 4 to 6% range. This has been achieved through a combination of monetary policy tools plus supply side intervention and fiscal measures. RBI had used repo rate adjustment judiciously, while the government had taken steps to manage the food prices. Reduce import dependency also is a critical move on the part of the government. This contrasts with the US experience where inflation spiked to around 8% in 2022. That is the highest in last 4 decades, and Fed had to take some extreme action. It just went on increasing the interest rate significantly in US. This aggressive monetary policy responses affected market sentiment and valuations in US. The US Federal Reserve implemented rapid and significant interest rate hikes, moving from 1.5% in 2021 to over 5% in 2023, just in 3 years, in response to inflationary pressures. In US, interest rate has increased more than double. This aggressive tightening cycle led to increased borrowing costs for many businesses and consumers, potentially slowing down the economic growth and affecting the stock market valuation also. We all remember the turmoil that happened in the banking sector in US. The RBI, on the other hand, in India, had taken more gradual, precautionary approach to increase the rate. And it had increased the rate from 4 to 4.5%, then 6.5%. This measured, careful strategy had helped to maintain a balance between controlling the inflation and supporting the economic growth, providing more stable environment for the Indian stock market and the companies. The relatively lower interest rate in India have supported business expansion, consumer spending, contributing to the strongest performance of Indian market, which you are able to witness now. With this, there is another interesting development playing out in India. What has happened in 1980s in US is happening in India right now. In the last 3-4 years, financialization of Indian household is happening. The number of individual investment accounts in the country has been more than double since 2021. Now it is surpassing 130 million. This dramatic increase in the retail participation had been driven by many factors such as increased financial literacy, proliferation of user-friendly investment apps, growing middle class income with high disposable income, the rise of systematic investment plans in mutual funds had also contributed to the steady inflows to the stock market. Currently, every month, more than 23,500 crores is the SIP flow. This is the amount which is flowing as SIP to Indian market. This influx of domestic capital had provided a stable foundation or stabilizing force for the Indian market, reducing the vulnerability to the foreign investment fluctuations. Whenever there is a dip in the market, I'm sure you would have observed, mutual funds are pooling the money supporting the market. Currently, fund houses are sitting with 1.8 lakh crores and waiting for the money to be invested. In contrast, what's happening in US? While the US has mature retail investment market, it has not seen the same level of dramatic growth in the new investor during this period. In addition, government policies have played a critical role in India's market performance. Everyone had the fear that this is not the majority government, but the policy stability and the continuity in the new government has been highly valued by the investors now. Initiatives aimed at boosting the domestic manufacturing, they have attracted huge foreign investment and created new opportunities for Indian companies. India's rising prominence on the global stage has been another contributing factor to its stock market success. As international companies seek to diversify their supply chain and reduce dependence on China, which is famously known as China plus one. So, this is an alternative for manufacturing and investment, the strategy which is adopted by West. So this China plus one strategy are also adopted by many multinational corporations. They have brought new capital technologies to India, supporting both economic growth and stock market performance. With this Fed rate cut, the US market may go up in the short term. It's really doubtful that problems in the fundamentals will improve fast, or in long term will it be able to beat Indian markets? Because please understand this factor. This time India's stock market growth is coming from improved fundamentals, not from some rate cuts or monetary policy. I'm not telling this. Look at S&P Global report. In its report, India Forward, Emerging Perspectives, it is said that public capex, which is continued to grow in double digits in FY 2025, increased capital expenditure, consumption, private investment and controlled inflation will make equity market in India further competitive. Recently, foreign inflows too have increased in Indian bonds because India has joined major emerging market. So India will now have a tremendous opportunities in various sectors, be it agriculture, trade, AI, energy sectors. So the country will grow at minimum 6.8%. India's per capita income is still around 2,800 US dollar. It has long way to go. But this doesn't necessarily indicate a decline in the importance of US market also. US still hosts many of world's most innovative tech companies and maintain a significant role in global economy. But the problem with the US market is this kind of Fed rate cut may lead to another bubble in 1 to 2 years. And if the fundamentals do not improve, you know what is going to happen? As an NRI, when you have opportunities to invest in different market, have a cautious approach. Look at the fundamentals and then decide. That's it for today. See you with another video. If you like this kind of video, please share this video in your friend circle and subscribe my channel and press the like button. And if you have any different perspective or opinion on this topic, don't forget to write it in the comment section. See you next week. Till then, bye-bye.